All right, welcome to the April monthly market and economic update. Shane's joining us this month. Welcome, Shane.
Hey, Chris, nice to be here, and certainly just commenting off air that it's hard to imagine that it's April already and Easter's past us, so it's a little bit of a scary thought that year's skipping by.
Absolutely, school holidays. Talking to Naomi, my wife, the other day and thinking, how are we here at school holidays and then term 2 starts, and before we know it, footy's here.
And we'll be complaining about the Bombers losing every other week. So.
All right, so let's get into it. GDP growth across the world.
Yeah, it's an interesting time, isn't it? And I think we've had a fairly consistent theme talking about GDP growth for the last 12 months now. And it's certainly driving share markets and interest rates. And these charts are so fascinating. And I still think in time it'll show that these spikes that we're seeing in these charts are, quite prolific in the history of time.
Absolutely.
But certainly GDP growth is moderating and it's starting to kind of form a heartbeat again by the looks of it around the globe.
Yeah, absolutely. And I think that first top left chart, for those who have the chart pack with them, for those who are listening on the podcast, you can download that in the show notes to look through this, but you can see how we're starting to level back out again into, I guess, what I would call quote unquote normal range, which is nice, but obviously it's still hot debate for, as it always is, like where are we headed and then how does that translate into financial assets?
Yeah, and it seems as though in the last week or so in particular, we're starting to see kind of data that's indicating GDP might be trending back up again, or at least showing some signs of strength.
Yep.
Which then, as we'll talk about in a moment, is interesting kind of segue into what happens with interest rates.
And I think that's the big question that everyone's really asking at the moment or wanting to know, right? It's like it's all in the mainstream media, then that's topic of conversation across dinner tables and around the water cooler. So it's a little bit here, I guess, GDP growth in Australia. Shane, I kind of was talking about GDP growth around the world. As for the last data set here in the land down under, we're still sort of trending downwards, which is, I guess, slightly, well, it depends on where you look geographically, right? In the US, it's kind of strong. UK, not so much. Australia, still trending down. So depending on where you're looking at it, the results or the data is showing differing levels of outcomes.
I think it's also a little bit too, and I think we probably experience this today here in Australia, living every single day, is that certainly the GDP growth on aggregate it tells one story, but the chart on the right here talking about where the breakdown of GDP growth comes from is equally fascinating. And you'll see there that government spending is still contributing or largely propping up the economy, whereas in areas such as discretionary spending, kind of areas specifically, probably trending down a fair bit.
Absolutely.
And the bite from interest rates for those that are kind of interest rate sensitive is certainly notable in parts of the economy today. Yeah,
and I think that'll be relevant when we get down to one of my favourite charts with the household savings ratio and consumption. There's been some changes from last month, but it's very interesting. So, inflation, I guess the big talking point for probably the last 3 years, really. More of the same.
It'd be nice to get to a point where we actually stop talking about inflation, just getting this nice, healthy little band. But I think interestingly enough, inflation today is still trending down, right? And we still in Australia haven't quite got to that 2 to 3% range the Reserve Bank would so desperately love.
Yep.
But we're getting closer. It was last week 3.4 thereabouts. So we're certainly getting closer and closer, and it feels as though as we get closer to this arbitrary number that we seemingly want to find, the world kind of starts to it's getting a bit tighter as to how we actually get there, and the correlation then with interest rates is will it won't it get cut at some stage this year, right?
Yeah, absolutely. And I think that, to your point, that will it won't it is what's really driving markets at the moment. And I guess we'll come to that. But in terms of how things are moving around, the markets are always looking for what's the trend direction. And I think it's pretty clear at the moment that whilst there's a clear trend down, where does it end, and how does the Reserve Bank fine tune that with the instrument that they've got?
Yeah. And interesting, yesterday, we're recording today on Wednesday, the 3rd of April. Yesterday, the Reserve Bank met and talked about interest rates, and it was the first time in the minutes of the meeting, that there was not a discussion about an interest rate rise.
Yep.
So it feels as though that the Reserve Bank have have kind of put the queue in the rack now with regards to, are we going to raise rates? It's now a question of how much we can tolerate and for how long we can tolerate.
Yeah, correct.
Of a rate level where it's sufficiently restrictive.
Yeah, and I think that rhetoric has been reflected across the globe as well. I know the Fed are doing similarly. I guess the Bank of England are probably in a different boat because their economy's not as holding up as well as the rest of the world. But that's still the communication out to the market. You can just sort of see where they're headed by the tone of the media releases that they're putting out. All right. So last month we went through a bit of this in terms of CPI inflation around the world. Nothing much has really changed there. But I guess one of the big factors for the Reserve Bank, especially over the last 12 months or so, and this is very much replicated in the US, has been about wage growth and service sector inflation.
And it's sticky, isn't it? It hasn't gone away. And probably particularly, I mean, it's one of those buzzwords that we always hear, service sector inflation and wage growth are getting stuck in there. And really, it basically means the wages are going up for people, but not going back down, or they're not. It's not kind of a little spike and then reversing. It's actually going up. Unemployment's holding its own.
Yep.
So typically speaking, what we look for in kind of economic data of this nature is to see wage growth reverse, which is seemingly what the Reserve Bank wants. Unemployment needs to go up.
Yeah, correct.
So that we see people lose their jobs and it kind of levels out the market or the demand for employment. But it hasn't happened that way right now. So this is still that kind of X factor in the inflationary world of, do we see it get back down to its 2 to 3% range and hold there?
Yeah, I think that's the difficult part of the job, right? Given that where wage price growth is you're trying not to break it all at the same time, kind of calming this down a little bit. Because if you can look at that chart, for those that have got the chart pack in front of them, that's been a steady incline, and I think what is that? That's is that a 30-year time frame? We're above average compared to or where the trend should be. So yeah, it'll be like I use this word way too often, but just interesting to see how it kind of plays out. Hoping that it's not too much of a detrimental.
And look, sort of thinking about it philosophically, I mean, the fact that wages are going up over what has been a very benign period of time for wages growth is actually not a bad thing philosophically.
Yep.
It's going to take a fair bit of recalibration for the world to get used to higher prices in services in particular. And I think the GDP growth we talked about on the previous page is indicating that we're not going to have a recession.
Yep.
So therefore, we're not likely to see unemployment or people losing their job en masse if we do really have a really nasty recession.
Yep.
And you made a good point before about somehow you've got to disrupt it all. And I think the words of Paul Keating back in the recession that Australia had to have was basically the same conundrum in a way, right? Needing to really break it to fix it in a way, whereas we're seemingly muddling our way through it.
Yeah, I think the one thing that when I look at this, sometimes I think for those of us that have debt, it's doing a nice job of reducing the real size of that debt. So it's an interesting, like if you're looking at the flip side of it, if some people are like high inflation bad for longer, but for obviously in the long term. But I look at this sometimes and say, for those with debt, it's reduced the size of the debt by 4% in real terms, and if your wages are going up, then that sort of helped really. So because there's a bigger debt, I guess, theme going on in terms of government and private debt behind all of the economic market stuff that's going on, that could be considered a concern in the long term, but it's probably just not in.
Yeah, and this is
asset markets.
It's always the dichotomy, isn't it? Governments don't want inflation in one hand because it causes problems, but on the other hand, they love the idea of inflating their way out of
this is
an economic situation, right?
Sorry, that was a clear digression from where we were, but I just find it really interesting. It's like I do wonder whether there's to your point exactly about governments inflating their way out of the debt issue that we've got ourselves into.
It's easier than paying it back.
Sorry? It's definitely easier than paying it back, that's for sure. Business survey, business sentiment, sorry.
Yeah, well, I think this is following trend, isn't it? Kind of looking back historically, the health theme of COVID kind of played a massive role in sentiment. But today, really, the interest rate cycle is still causing sentiment to be lower. And it's not just on, we always think about sentiment at a household level, but businesses too, suffer from sentiment insofar
Absolutely.
as their willingness or preparedness to invest and expand when they can't really calculate the true cost of capital.
Yeah,
So I
correct.
do wonder, maybe, given that yesterday the Reserve Bank, all but put the queue in the rack with regards to interest rates, whether sentiment actually starts to shift over the next sort of 4 to 6 weeks.
Yep.
Not necessarily because we're feeling better about the world, but because we've got more certainty about what the ceiling looks like in
Yeah,
regards
absolutely.
to interest rates.
Yep. Because like anyone, right? If you're looking to invest, you want some certainty in the near-term outlook to give yourself some comfort to spend that money. So an interesting point though, because I think last month we had a look at the business investment there on the right-hand side in the green, and it's going up quite sharply. But you can see over the last month that's kind of held steady. So it'll be an interesting one to keep an eye on for next month, just to sort of see how that plays out. And now this is my favourite chart, the one on the left there, the household income and consumption. Last month we were talking about savings ratio just continuing to plummet, and there's a nice little uptick on the bottom of that now, which is good, because I was looking at that, getting a little worried that we were hell-bent going to zero and past zero. And then this just disposable income has ticked up back to close to zero, which is good. But to your point before about consumption, that continues to fall.
Yeah, and sentiment on the previous slide too, right?
Yep.
So it's interesting though. I mean, what I think the data is showing in some respects is the world is tolerating a higher level of interest rate.
Yep.
So, it's arguable that perhaps given the world is muddling its way through with this level of rate, it may disappoint us on what the expectation for rates being cut might look like in the next 12 to 24 months.
Yeah, I think so. I think the more data comes out, I think the more likelihood that people are going to be disappointed from what they're, I guess, expecting. And I don't know whether expecting is the right word. I think there's probably a bit more hope out there, because obviously financial conditions are tight. So, everyone's wanting that to ease a little bit. Just don't think it's probably going to happen as quickly as people want.
Yeah, agreed, yeah.
So in terms of economically, how does that then translate into what we expect from markets? These have been the scenarios that we've been looking at over the last, that's probably more than 2 years now. But again, from last month, nothing much has hugely changed, right?
No, I don't think it's really changed, and I think it's sort of, we've used the phrase, muddle our way through a couple of times today, and it seems like it's certainly the kind of the theme that we've been talking about through.
Yep.
Having some volatility in the process, and we've been very fortunate, and we'll see equity market returns in a moment. We've been very fortunate with equity markets in the last little while, which kind of masks a little bit of the underlying
definitely
economic data. It makes us feel better about the world in any case, because equity markets are going up at a rate of knots. But now we're getting to this point again where pricing through of interest rates has been largely factored into the market.
Yep.
I think we're going to see now this middle theme that we've been discussing for a while.
Yep.
Maybe re-emerge now if we don't meet expectation in regards to when rates get cut.
Yep.
So they've been factored in. If it doesn't happen, this volatility theme will start to rear its head again, I suspect.
Yeah, absolutely. And I think to Shane's point there about our expectations, I think that is market participant expectations. So as you'll see, if we flip through here to equities, so that's our bond markets, we'll come back to that. But the equity market performance for the last 12 months, like if you look, say, back from November last year, things have gone insane, essentially.
Yeah.
And that's essentially the market's pricing. Interest rates are coming, lots of interest rate cuts are coming, things are going to be great, and hasn't really, to your point, kind of taken into a fact that maybe we are going to see rates higher for longer.
Well, I think this is really. I mean, the US have been factoring maybe 3 or 4 rate cuts this year, and the data that was out yesterday, starting to shift that a little bit to maybe 2 or 3 rate cuts. So I do wonder, the volatility that's built in here. The growth that's built in here is a little bit of volatility that comes as we, kind of normalise what is, what will be the level of rate that we hold.
Yeah, it's interesting because that rhetoric changes hasn't necessarily yet translated into, that in the market. The market's kind of looking through that and saying, yeah, but it's still coming. Yeah. So we'll just continue sailing on. So
it's having a nice party at the moment anyway.
Absolutely.
And look, it's so good to see the market so strong, because we've lived through a pretty difficult period of time, and to enjoy some strength in the market, and it's nice reward for investors' patience. I think more than anything through what has been a really, if we go back to 2020 when the volatility started, to
absolutely
4 years later, it's been a fairly taxing time for many investors. So to see some strength and reward of patience is really pleasing.
It is actually, because it's I think there was some fatigue in there in a lot of those conversations about will this ever turn around. So if we jump back one to bond market performance, I'm still, as for those who watched last month, flabbergasted by the amount of volatility that we've seen in bond markets. That was a one in sort of 40 or 50 year event, but we're still seeing, I guess, some pickup in returns in this space.
I think you made an interesting point before, Chris, about the share market's already. The timing of interest rate cuts, the share market's still looking through part of that, saying, well, they're still going to come anyway, right? The bond markets are far more sensitive to those movements, and even looked at last little bit, for the last month or so, just trending down a touch. The US 10-year Treasury has been shifting up a little bit as GDP data looks a bit healthier, and unemployment looks a bit healthier, wages look a little bit stronger. So it's so interesting that the bond markets respond almost immediately, whereas equity markets are sort of seemingly looking through all that and just marching to the beat of their own drum in a way.
Yeah, correct. Yeah, it's interesting. Again, comes back to that diversification discussion that we're probably just about to launch into. And as always, staying to your point before about being patient, it's pays off in the long run.
Yeah, look, I think portfolios this year are tracking along pretty healthily, even with bond exposure, where we're seeing a little bit of return come back in bond exposure. Investors getting rewarded with high cash rates now as well. Equity markets have been strong. So I think the theme, as always, is that I know we're not capable of picking which one of those asset classes is going to be the best one in any given year. So it's that discipline of asset allocation, sticking at it. And as we were saying before, is really being rewarded for that patience for now. And as to what happens next, that's what our asset allocation models do, is to make sure that we've got enough buffering around all edges of asset types to ensure whatever does happen, that we've got diversity in there to try and mitigate as much risk as we can.
Couldn't have said it better. Excellent. Disclaimer as always. Obviously, none of this is taken into your account, your personal objectives, financial situation or needs. But otherwise, that's it for this month, Shane. Thanks for joining us.
Thanks, Chris. That was fun, and let's hope that we see some movement in data next month, where we can see some positive stuff for investors as well.
Excellent. All right. Thank you all.
Bye for now.